Wall Street stemming a 4-day losing streak, at least for now, at least as of the noon hour. Retail and tech stocks leading the way higher. No Santa Claus rally, obviously, this year, but we got the next best thing in Jolly St. Nick. We've got Nicholas Colas. He's co-founder of Datatrek Research. Welcome back.
Thank you.
Nick. And after initial jump that we saw at the open, the S&P initially lost all of its gains below Monday's already low. Despite the strong numbers we got from retail. What's your read into the trading that we've seen so far this morning?
It feels very much the market's trying to find a bottom. Current fundamentals aren't really the issue. We knew Christmas was going to be strong, so I think that's why that data didn't really have a lasting impact. But the market now, first of all, is just exhausted from all the headlines in Washington, and I think also a bit exhausted from all the tax law selling that we've seen over the course of December. So hopefully this is the beginning of a stabilization process, with markets saying, okay, we've priced in enough uncertainty and enough tax law selling that we're pretty good through the end of the year.
Hard to call, but any sense that we're getting closer to a bottom? Or do you need to see that capitulation come in?
It would be lovely to see a capitulation. The problem is we're all kind of trying to predict the next catalyst. And I think the one thing investors have learned in the past month is when the market sells off, there might be a bad headline coming in 1 or 2 days' time. As we saw when the Huawei CFO was arrested over the weekend, and markets didn't really hear about it till Tuesday, and the headline didn't hit till Wednesday. So I hear from clients a lot that they're just sitting on the sidelines because they assume every big drop is a sign there's another bad headline coming in a day or 2 or 3, probably political.
Clients sitting on the sidelines. Now, you always have these wondrous reports with great headlines. One saying the marshmallow test, and I couldn't help but read that. We don't have time to get into that, but it was about behavioral finance, which you're really into, and about what people are searching online, the search terms when it comes to the Dow and some of the indexes. What have you learned from that?
Yeah, the basic message of both studies is simply that investors, they don't just dislike uncertainty, which we all know. They really value certainty, and certainty is the hallmark of why people invest, and they'll invest more if they feel the environment is certain. What we've seen is a lot more fear, a lot more Googling of things like Dow Jones Industrial Average over the course of this year as volatility picked up. And I think it very nicely explains why, even though fundamentals still look quite good, the Christmas sales, for example, we still see people selling equities and selling pretty much at any price because they fear that next headline, or they fear what might happen with the Trump administration or the trade disputes or the Fed. And that's just been one more thing after the other and has collectively created this volatility.
But that fear hasn't risen to a point that says, hey, we're as a contrarian indicator now, it's time to go in, the markets are going to bottom out?
That's true, because on 2 points. First, those Google searches for, say, things like Dow Jones haven't reached the levels that we saw in February, which really was this cataclysmic volatility storm bottom. So we haven't seen that. Nor have we seen the VIX, for example, really get to those 35 to 45 levels where the VIX says, okay, this looks like a bottom. And I think investors also know that even when the VIX bottoms, you have to wait a little while before things finally wash out. So there's still this trepidation.
And Nick, speaking of those holiday sales, MasterCard out with that report saying that's the strongest growth we've seen in 6 years, up 5.1%. Are there any stocks or segments of the retail sector that you like, that you think are worth going into?
It is so hard because retail is one of those things where the market discounts all this. Retail stocks did have a great run earlier this year as unemployment came down, as wage growth began to accelerate. Now it feels very much like investors don't want to wait for another year for Christmas 2019 to see the good news again, and now we're beginning to see the narrative cycle back to what's Amazon going to be doing to retailers in 2019. So that's a very tough space, and right now we're advising more caution, more defensive groups, the staples, for example, that may not require a lot of consumer spending to keep going, but are much safer than consumer discretionary names.
So you're more on the defensive side, right?
Yes,
overall,
absolutely, yes.
Speaking of defensive, there's a Wall Street versus Main Street thing. Main Street seems to be good, the fundamentals are good, it's Wall Street that's really down. But what happens when the 401k statements come out in January? Does that customer then become the investor thinking, wow, things are really bad, maybe it's time to crimp down on the consumer spending, and what if the tariffs rise further?
Yeah, you got it exactly right. The stock prices are that transmission mechanism between Main Street and Wall Street. Wall Street will respond very quickly and with the volatility, as we've seen, and then investors, and more importantly, business managers begin to look at their stock prices either in a 401k or for their company and say, My stock's down 30% this year. Maybe we should not invest as much in the business next year. Maybe we should cut back on hiring or on capital expenditures because the market's trying to tell us something about the future economy. And that's my concern, is if we don't see stocks rebound in January, which they very well could, you're going to see investors get a little more cautious, and you're going to see business people perhaps start to hire a little bit less, invest a little bit less. And we could almost talk our way into a recession just with the volatility we've had so far.
Meaning the first 5 days of January are going to be even more important this year than the last?
They really are, because we should see a bounce. All this tax loss selling that we're seeing in December really should finally clear out, and the classic January effect, which you just alluded to, should be absolutely in evidence.
Okay, we'll be watching. Hope to have you back again.
Thank you.
Our thanks to Nick Cullis of Datatrek Research. I'm Fred Katayama. This is Reuters.